Guys, we need to talk. What's up, YouTube? Welcome back. Today we're going to be talking about the housing market today in 2023. Everybody knows interest rates have been sky high recently, the highest they've been in many, many years. Also, houses are going 100,000, 150,000 over their intrinsic value. They're starting to slow down a little bit, but today we're going to be talking about everything you need to know for buying a house in 2023. If you wouldn't mind hitting the like button down at the bottom of this video, that helps me out tremendously with the YouTube algorithm, as well as subscribing to the channel helps me provide more and more content just like this. All right, guys, let's dive into it. As we all know, interest rates have been extremely high right now, but what I'm telling you is that you can't let that deter you from buying an appreciating asset and something that's great to your financial portfolio, such as a home. What I'm saying is we could dive into it a little bit deeper and seeing if we could really pull out the true intrinsic value of a home and to see if we're getting a great deal here in 2023. Now let's look at the big thing right now, which is interest rates. I just bought a home personally. My interest rate is not completely terrible, but if you look at the interest rate compared to what I could have had 2 years ago, I'm paying possibly thousands of dollars more a month because just my interest rate went up a couple more points than what it was a few years ago. But if we look at historically, interest rates in the 1980s, 1990s, early 2000s were anywhere from 6 to 8 to 10%. So we're actually bouncing back to a little bit more of a norm than what it was at for the past couple of years, where it was 2, 3, 4%, which tends to be on the lower side of things. Now, after that little tidbit about interest rates, what are the really important things when you get down to the nitty-gritty of buying a house? People buy houses for many things, for primary residence, rental properties, vacation homes, etc., etc. There are three main things that you want to look at in buying a house. Number one is, how much of a house can you really afford? You could do certain calculations that you could find online. You could use calculators online to kind of get a ballpark by what your income is every month and kind of sort it out from there. What you could also do is you could go through a pre-approval process with a bank. What they'll do is they'll pull your credit score, they'll take some information from you, like your yearly income or your monthly income, how much money you have in the bank, and then kind of see how much of a home you are really approved for. Number two is, how much do you want to put down on the house? How much income or money do you have in the bank that you're okay with letting go of to put down on a house to lower the amount you're financing through a bank? And number three, and what we talked about, was interest rate. What's your interest rate going to be? What's it looking at based on your credit? And also, are you going to use points to buy down your interest rate? And we'll talk about whether that's a good idea or not later. Number one, like I said, is the amount of house that you could afford. And I've linked in the description a mortgage calculator based on the down payment that you want to put in, everything, and you could sort out your finances through that and look at the type of house that you could afford. But you have to remember that the down payment and your mortgage isn't everything that you could afford. So my wife and I were a little bit surprised when we were going through the buying process, and we were, all right, we had this money put aside for our down payment. We knew what our monthly mortgage could be and everything like that. But what you need to put into account is closing costs. Closing costs could be anywhere to 3 to 6% of your overall loan. So you have to take that into account as well and make sure you have money for closing costs. So what are closing costs? Closing costs are services provided by the lender to kind of get your loan all sorted and your titles all figured out and all that stuff. So what most first-time home buyers do, and what I did personally, is you grossly underestimate the money that you need to bring to the final closing day. So that's what I did. That's what my wife did. Luckily, we had enough money in the bank to figure it out and pay everything right then and there. But what you should always do is ask your lender, what is our cash to close? Cash to close takes into account your down payment on your house, what you want to put down, and also how much are the closing costs going to be and any other fees that need to be assessed. So my advice is, When it comes to finding the house, the amount of house that you could afford, go get a pre-approval letter from a bank, see how much house you can truly afford with your income and all your means of revenue. What you could do after that is take your down payment and see how much of a loan you're really going to assess. Take about 5% of the loan that you're going to assess, add on that for closing costs, and see to make sure you have enough money. My advice is, even if you're okay and you get pre-approved for a higher amount, I would only buy a house about 75 to 80% of what you're pre-approved for. This is simply because when you take less money and you take a smaller house than you could overall can afford, that means you have more money at the end of the month where you could start ticking off that principal of your house instead of just paying interest, because of how loans and mortgages are structured, and I'll explain more of that later. As I was saying, it's a great idea also to get a pre-approval letter, because some realtors won't even show you a house until you have a pre-approval letter showing that you're pre-approved to purchase that house if you end up wanting to get that house. My advice too is I would always use a realtor, simply because of the fact that they know what they're doing, especially if you're a first-time home buyer. They have all the ins and outs of the real estate market, knowing what the values are. They have access to see what the comps are, and I would always use a realtor or a real estate agent to help me buy my house. Also, if you're worried about paying them at the end and worrying about how much you're going to have to fork out to them, that's okay. You don't really need to worry about that, because you do pay them, but you pay them indirectly. You pay them on the sale of the house. So when you go and you end up paying for the entire house, going to closing, you put your down payment down, you write the check at closing, all your cash to close is there. The realtor then gets written a check by the titling company or the lender for the amount that they get. A realtor could save you a lot of heartache in knowing the intrinsic value of the properties and comparing comps to make sure you're actually getting a good deal on your property. What you're not going to get a lot of help with, and what you should always do, is shop around for interest rates. I think you should get anywhere from 3 to 5 quotes on interest rates, what your cash to close is, how much you want to put down, and this is not including buying points. Many of you may ask, what's buying down points? Buying down points is essentially paying money up front to the lender to decrease your overall interest rate. Very unlikely you'd want to do this, but sometimes it's beneficial. Sometimes the cost of buying down your interest rate saves you a couple $100s a month and will allow you to put that money to better use elsewhere. Buying down rates isn't always the best, because what you could do is just pay off your loan and later on refinance at a lower rate and still have that money in your pocket. But everybody's financial situation's different, so you have to do what's best for you and see if buying down points is best for you. The final thing is how much of the house can you afford and what your monthly payment is going to be. Obviously, you have to be happy with your monthly payment and you have to be able to afford it. The bank is going to run the numbers and run your monthly debt to income ratio. What they're going to do is they're going to look at your finances and how much money you're putting out that month to make sure you'll be able to make those mortgage payments each month. Obviously, we have to be happy with our monthly payment and we have to make sure it aligns with our financial goals. Everybody's financial goals are different. If your financial goal is to have a big extravagant house, maybe you want that a little bit more than going out to eat a lot of times a week or having this nice new fancy car. Everybody's financial goals are different, so make that choice on your own, okay? With all this being said, everything needs to line up with your financial goals. Personally, I would advise anybody who can put down 20% on a house to put down 20% on a house, because this allows you to avoid PMI. PMI is private mortgage insurance, and what it essentially is you have to pay the bank a little bit more money, being that you didn't put 20% down and have 20% equity in the house, because what this allows them to do is save themselves if you end up defaulting on the house. So for those of us out there, I'd put down as much as you feel like you're comfortable with, making sure that you still have money in the bank to cover those closing costs, the down payment that you want, also to make sure your monthly payment is what you want it to be. Like I said, I would go for a house that's about 75 to 80% of what I'm pre-approved for, so I have money in the bank. The way mortgages are structured, you're going to be paying interest for the first 12 to 15 years of that loan. So what you can do is you could pay those loan payments with paying a little bit extra every month, because you have a little bit more in the bank by not buying as big of a house or as expensive as a house as you really wanted. With that extra money, what you can do is you could actually decrease the life of your loan by half by doing the 10-15 strategy. What it means is every month you put an extra 10% to your mortgage, and that means you will have your mortgage paid off in 15 years if it's a 30-year mortgage. What you could also do is, if you don't have that much money on hand, you just putting an extra $100 a month towards your mortgage decreases your mortgage term anywhere from 4 to 4.5 years. So a quick overview: always shop around for interest rates. Always know how much money you want to put down to put yourself in the best financial spot you possibly can. And 3, always make sure you remember closing costs are a thing. Guys, I know this is a lot of information, and I know this is a lot of stuff being thrown at you at once. If you guys want any more descriptions on anything else, what it's like buying a primary residence, a rental residence, whatever that is, comment down below. Make sure you like, make sure you subscribe. Can't wait to see you guys in the next one.